Welcome to today's update video called Breaking Down Barrier Income. Breaking Down Barrier Income is a monthly series featuring Simplify's Barrier Income ETF, ticker symbol SBAR. SBAR launched in mid-April 2025, just over 8 months ago. Today we will be reviewing the month of December 2025's performance. We believe Simplify is transforming the structured note experience by providing an outcome-based solution in a liquid ETF wrapper. My name is Jeff Schwarty, Chief Equity Strategist at Simplify. Today I'm joined by Emilio Frede, Lead Portfolio Manager for SBAR. Emilio, Happy New Year. I hope you enjoyed the holiday season and welcome to today's session.
Thank you, Jeff. Happy New Year to you too.
Happy New Year. In today's video, we'll be reviewing performance. We'll talk a little bit about distribution yield, remind investors of the operational benefits, and then dig a little bit deeper into some observations that we're seeing with correlations and volatility, where Emilio will lead that effort. So let's just jump right into today's discussion, and I'm going to bounce over to the presentation. So we continue to have a just under 13% distribution rate. These are numbers at the end of November. 12.93 is the distribution rate. It's been 28 cents each month since launch of the strategy. So very attractive double-digit yield. The SEC yield has dropped since launch of the product because Treasury is normalizing interest rates. So we would expect that to move along with the Fed policy on interest rates. So investors have been enjoying that double-digit yield, which is super attractive. As far as performance, I'm going to give you a comment around launch performance to date, and then Emilio will talk a little bit about December. So since launch of SBAR in mid-April 2025, you can see 13.5% total return with a 10.5% annualized volatility. You'll notice since the inception of the strategy, upward trending to the right, which is very consistent with equity markets. There were a few particular drawdowns. You'll notice in, I guess, early November, that was given the government shutdown. And then December was actually pretty attractive. Emilio, any comments about December's performance?
Yeah, I mean, December was another strong month for SBAR. Performance-wise, we had a 1.2% return over the month with SPX almost flat. And this was a function of two things, Jeff. So first of all, as we mentioned in the last video, we were able to generate higher premiums on the positions that we opened in both October and November, right, due to those multiple volatility spikes. And then second of all, as volatilities came down for most of December, VIX went down about 10 points from the peak of November. We enjoyed a nice rally as those short puts lost some of their value rapidly, right? And this is a decidable dynamic with this type of strategy. These short-lived market corrections and volatility moves followed by a market recovery and volatility crash, right?
Yeah, that's a good observation, Emilio. I know in early September we had written some options and the yields were quite attractive relative to the ones we wrote end of November. And we're still seeing heightened equity volatility, and that affords higher option premium that we're able to generate for SBAR. So that can offset some of the reduced yield coming from treasuries, which again, there's two drivers of income, one being treasuries and one being the option premium that Emilio and team are able to generate for the product. As far as the use cases for SBAR, we get asked a lot, where does this fit into an asset allocation? I feel like it's obviously tilted towards investors that are thirsty for income with that double-digit distribution rate. It can serve as an alternative to equities because it does have this 30% barrier, which means at the expiration of each of the option contracts, if we've broken the barrier in the worst of three indices, that particular position would participate. However, if returns are not breaking the barrier, then you have zero drawdown from that unique position. Again, we ladder those positions, so it provides a little bit of a cushion for equity volatility, and then really for an alternative to bonds because we are generating a distribution rate, limited duration and credit, and more importantly, no counterparty risk because we have the capital from the counterparty when we write the option contract. So it fits nicely into a group of investors thirsty for yield. As far as how are we improving the structured note experience, I think the biggest one for me is just liquidity. If investors buy SBAR enjoy the distribution yields as they own the particular position. If there happens to be a life event where you need capital, there's no breakup fees, there's no locking up of capital. You're able to enjoy the liquidity of any sort of ETF in the marketplace. And then operationally, we take a lot of that burden away from advisors. They're using structured notes. Emilio and team are watching these positions every day, getting multiple quotes from brokers. And then we believe we're offering a lower cost solution than direct to investment banks for the exposure. So feedback's been great. We've got a lot of good feedback on SBAR as well as XV, which is very similar to SBAR with a 25% barrier, and then XXV, which is our single stock ETF with a target yield of 25%. As far as how we're enhancing the strategy versus what you could get from an investment bank is we got the callability feature, which is a super cool feature. If the underlyings rise above the initial value, that gets called after the non-call period, and then we do the worst of. So we're looking at three different indices: S&P 500, NASDAQ 100, and Russell 2000. As far as positioning at the end of the year, you'll notice we have 40 positions with Friday maturities a year plus out. We're looking at about 29.1%, which is the notional weighted to the barrier amount. So that would mean the entire portfolio would have to go down 29% to participate in aggregate. With the 327 days to maturity, we have the distribution rates on the right-hand side. You'll notice when you look at the x-axis, that's the notional weight of each of the positions. So very diversified portfolio of bear option positions. And the dashes on the graph at the top represent the best, worst, and average performance of those three indices. The one that really matters is the bottom of the dash. And so very consistent in how we've been running the strategy from launch. Emilio, maybe give some color or some views on the hedging that you guys have done in the portfolio.
Yeah, as we mentioned last month, Jeff, we have the ability to add these low-cost hedges in the portfolio via vanilla long puts on any of the three equity indices that we have in the baskets, right? S&P 500, NASDAQ, and Russell. When we believe there is an opportunity to get high amounts of notional for minimal spend, covering around 2 to 3 months of protection with strikes close to our barrier levels, right? So roughly 20 to 30% out of the money. These hedges, as we said, can have very attractive potential payoffs that could help the portfolio navigate these periods of market stress, right? So given the lower volatility environment in December that we just talked about, we decided to add a new hedge in the portfolio. In this case, it was an SPX put expiring in February, so 2 months of coverage at the time, and around 20% out of the money, right? We spent roughly 12 bips, which translated into 100% notional coverage at the time on portfolio level. For reference, on the cost, Jeff, this hedge configuration, like 2 month, 5 delta put, was at its cheapest level in almost 2 years, right? So we decided to add this new leg in the portfolio. We already had this January put that's expiring in a couple of days. So we wanted to keep the protection on.
Yeah, Emilio, I would say that's the biggest differentiator versus other competitors in the auto call space is really that ability to actively put on a hedge in the event that we can afford to get 100% notional. I think that's a really big differentiator for us, and I appreciate the insights and the color on that. I think of it as like flood insurance. All of us have property casualty insurance on our homes. This is like flood insurance, so you're providing extra layer of protection. Or maybe seat belts and airbags on a car, maybe is another example. So this particular report is published on our website every single week. So you can see it under the SBAR tab on our website. Investors can see exactly how things are positioned in the portfolio. As far as the Fed's normalizing of interest rates, we did get another cut in December. You can see from the first part of the cutting cycle, we're looking at the short-term rates of down about 78 basis points. Again, that impacts the treasury yield component of SBAR's income stream, not necessarily the option premium level. Any comments on rates normalizing, Emilio, or is it pretty self-explanatory?
Yeah, I think it is. I mean, as you already said, right, we have these two independent components, the income from the barrier puts and the treasury yield. So this slide is just highlighting that, the last few rate cuts, would normally reduce the yield coming from that treasury component. But as we were saying before, due to a favorable market environment, the yield that we've been generating from the barrier put selling since inception has been on the high end of the range, right? As we will see
Yep.
on the last couple of slides, around, I think, 11% in just 9 months. So, it's been compensating for that reduction in rates. Yeah.
Yep.
But it's two independent components anyway.
Yep. Yep. And then, whoops. And when we look at volatility in the marketplace, obviously the tariff tantrum was the big issue in the first part of the year through middle of April, and then the government shutdown kind of in that October, November time period. And we have seen vols drop here towards the end of December, which is what Emilio pointed out earlier. Any comments around realized volatility or implied volatility, Emilio?
Yeah, I mean, let me walk you through the last couple of slides regarding the underlying volatilities and the pairwise correlations. As we said, the two main sources of risk premia in these were soft baskets, right? The general dynamic is, higher uncertainty, higher premia for the basket, right? So higher volatility, higher premia, but also lower pairwise correlations, higher uncertainty and higher premium for the baskets too, right? It only takes one name to get through the barrier for
Yep.
the put to get knocked in, right? Which means if the names are, have low correlation among, each other, there is more uncertainty
Yep.
for the put, right? So higher premium. What we have here is the time series of volatilities of the three different underliers, S&P, NASDAQ, and Russell for 1 year maturity and 20% out of the money strikes, which is a good proxy, I think, for the type of volatility that we sell in the fund, right? Since launching, as you were mentioning, Jeff, SBAR in April 25, we can distinguish like multiple volatility regimes. So this very high vol environment at the beginning with the equity drawdown of April and the tariff tantrum situation. That was great for capturing high premiums after launching, right? And then we have this recovery period where equities rallied and vols collapsed, which again was great for the callability feature, right? We were able to collect most of the higher premiums from previous months. And then after the summer, since October, we've been seeing these episodes of higher vols followed by quick market recoveries, which, as we explained before, again, we can benefit from this type of environment, right? It's important to highlight what you were saying, Jeff, that even though volatilities came down during December relative to the peak of October and November, we're still seeing levels well above those of a year ago, like December 24 and the beginning of 2025, right? Possibly
Yep.
driven by the general higher uncertainty in the macro and geopolitical environment.
Yep. Great. And then you mentioned, Emilio, I think it's really important to highlight on this slide, we get higher realized premiums with increased volatility, but we also have an extra layer of premium that comes from pairwise correlation. So as those benchmarks diverge from each other, there's greater certainty that one of them would break the barrier. Therefore, you get a higher premium from that episode. So comments around pairwise correlations?
Yeah, so this is the time series of the rolling 3-month pairwise correlations between the underliers in the basket, which is a measure of how closely these names move relative to each other, right? And we can see the same dynamic, as you said, that we just talked about for vols now from the perspective of correlation. So generally speaking, in period of market stress and higher volatilities, the three equity indices will tend to correlate more with each other, right? And the opposite is true for periods when the market is calm and moving higher, like these correlations become much lower, which helps maintain a good level of premium when the volatility risk source is small, right? And here we can see these correlations have been coming up over the last 3 months, which is consistent with what we said, right? The higher volatility environment of October and November, right?
Yep.
2025.
Yeah, great. Okay, well, there's our good-looking portfolio manager, Emilio. So let's do this. I'm going to thank Emilio for joining us today and remind investors that we believe the monthly income is super attractive for investors. That income is generated from treasuries plus the bearer option selling. And we think these are great investments for investors that want to participate from an income perspective and have some drawdown protection in the form of those bearer options, specifically 30% for every option position in SBAR. So thank you for joining us today. We appreciate your interest in SBAR, and if you're an investor, we appreciate your investment and trust in us. Thank you.